Good morning, Hancock County. We are broadcasting live from the top of the Hancock Whitney Bank building in beautiful downtown Bay St. Louis. And today we are featuring a really important topic, flood insurance changes and what they mean to you and your business. And with us today, we have our guest host, Angelyn Zeringue, who is going to be introducing our featured speaker. But first, let me just do a little housekeeping. If you are zooming in, you can drop your questions in the chat box. And at the end of the presentation, we're going to take some questions from the audience. Also, if you are on Facebook, you can drop your comments in the comments or your questions in the comments section. So please jot your questions down. And actually, this is going to be sort of a little Q&A session with Angelyn, past president of the chamber, now on the board for the chamber in Harrison County, the Coast Chamber. Citizen of the Year, the list goes on, but she is our local resident expert on the insurance industry. And we do have so many questions now with the changes that are coming for the National Flood Insurance Program. So Angelyn, please take it away.
Thank you, Tish. Good morning, everybody. Welcome to the Hancock County Chamber Coffee Call. I'm really thrilled to be here. I'm a very proud member of the Hancock Chamber, and I just can't thank them enough, Tish and Ann and Jennifer, for everything that they do for our community and our businesses. And we thank you for joining us today. So the reality is that everywhere you live, there's some act of nature that can impact you, damage your property, and destroy your community. In California, they have earthquakes. In Oklahoma, they fight wildfires. In Michigan, they experience frequent tornadoes. In Arizona, flash floods. And here on the Gulf Coast, we deal with hurricanes, and that brings wind and flood. So far in 2021, FEMA has declared 97 federal disaster areas across the US. It's just incredible how much goes on. But if you know what your risks are, where you live and work, you can develop some strategies to help you reduce the risk. So there's four main ways to deal with the risk of flood that we are exposed to here on the Gulf Coast. You can avoid, reduce, retain, or share. So how do you avoid a flood? Well, you can move from the area, you can move away. Most of us choose not to do that, so we're going to look at some other strategies for doing that. You can reduce your flood risk. You can use flood mitigation. What does that mean? Build higher, build stronger, use flood venting. So there's a lot of ways that you can do that to help reduce your flood risk. You can retain your flood risk. You can self-insure, so to speak. So if you have a $150,000 house, and you choose to self-insure, then you need to save $150,000 somewhere so that you can rebuild your home in the event of a total loss. Or you can share the flood risk. And that would be using an insurance product through FEMA or some private market to help you, where you would pay a premium, and then in the event of a loss, you would pay just your deductible, and then the policy would respond to your loss and help you repair the damage and rebuild your life. So here we are today to talk about what is changing with the flood insurance market. A lot is going to be different as of October 1st, and that's Friday. Again, Tish mentioned we would love to have your questions, so please put them in the chat box or in the comments for Facebook. And if we can't get that to them today, we promise that we'll follow up with you and get responses to your questions. So today we have with us Patricia Latshaw. Patricia is from Wright Flood, and she's the Senior Vice President of Compliance and Training. And she's also the liaison for the FEMA NFIP and makes sure that Wright Flood is in compliance with the National Flood Program's rules and regulations. Patty has over 25 years experience in the insurance industry in all aspects of underwriting, operations, and claims. And then the last 20 years, she's been dedicated to the flood insurance program. So with that, I'd like to introduce Ms. Patty Latshaw.
Good morning, everyone. Thank you for having me here, and I hope I can provide some insight on the changes to the flood program starting October 1st.
Love it, love it, love it. So let's start with the background. Why are changes being made?
You know, when FEMA started out in 1968, it's all based on flood maps. And as you know, a flood map has a line between what's a high-risk area and what isn't. Unfortunately, Mother Nature doesn't stop at that line. She keeps going at times. So FEMA realized that, you know, there were a lot of properties that have more risk. They might have the same flood zone, but in different areas, it might be more riskier than others, the type of flooding. So they just wanted to come into the century here, the 21st century, and you know, have a program that is what they're calling more equitable. So we, like, for example, we saw with Harvey, you know, 80% of those properties that flooded were in a non-high risk area. You know, our X zones where flood insurance is not required. So they really had to do something. Plus with the debt, you know, they realized they're not doing rating correctly. So they've decided to take on the rating and update using modeling and things of that sort.
Well, cool. Yeah, I know it. And it probably did need to be changed, but can you describe what the actual changes are?
Okay, you know, the rating methodology that they used, you know, again, was the flood zone, your base flood elevation, your foundation type, structural elevation. I think I got muted there.
You're back.
Okay, I'm back.
Start
over.
Start again.
Okay, sorry. All right, so what they were using was the flood insurance rate map, your base flood elevations, your foundation type. Now what they're doing is geolocating a property. So it's not just an area, it's your home or your business that they're geolocating on. And then they're looking at the distance to coast. The river classes, if you're subject to river flooding, types of flooding, whether it's inland, you know, river flooding, storm surge, you know, coastal hurricane, you know, type flooding, your ground elevation. Now they're looking at ground elevation compared to your first floor instead of base flood elevation and your first elevated floor. Construction type, they're looking at masonry versus frame. You know, so they've got a lot of changes there. There are also the changes, you know, they wanted to simplify a flood quote. And a couple of years ago, FEMA invited me into their office to do a flood quote in an AE zone. And I should say it was the FEMA's contractor. And, you know, we spent 20 minutes trying to do this quote for them, an elevation certificate. And they said, this is just way too complicated for an agent to write and too complicated for an insurer to know all these questions right off the bat. So they wanted to simplify it. So, and then they realized elevation certificates are hard to come by sometimes. Somebody might not have one right away. So they're eliminating the elevation certificate as a requirement. They're using a third party for your first floor elevation now, or first floor height as they call it. So and that third-party tool that FEMA will be using. If they can't get that, they're going to use an assumption based on the type of building it is. So the good part is if an insured wants to complete their own elevation certificate, they can. There's a section in there to provide it, but FEMA will use whatever is best for the consumer. So if they do have an elevation certificate and it's better, they'll use it. If the first floor tool is better, they'll use that instead. So yeah, but that saves a lot of time. They expanded on mitigation discounts. Instead, it was just, flood proofed, or if you were properly vented. They've added where if your machinery equipment is elevated as well, you can get an increase there. One thing, the CRS discount, the community rating system, they used to base it based on if you were high risk or low risk. Low risk got a smaller discount. Now they're saying it's the same discount for everybody. They're not, it's not going to be dependent on your flood zone. They're looking more at the types of levees, dams, if that might impact something. They're factoring in replacement cost on properties. What they're also doing, and I know we'll probably talk about this more, but they're getting away from the preferred risk policy. That's not going to be available for those properties in those X zones. And they're going to eventually phase out grandfathering. So those are the big things that they're doing. Also, they're going to be taking a look at claims, and more importantly, prior claims for rating. So those are the big changes.
Well, there's a lot of changes. I mean, that's just huge. But let's get to the bottom line here. How is this going to impact consumers and businesses?
Well, FEMA did a survey, based on their rates, is they're looking at about 23% of policyholders will see a decrease in premium. And probably 70% will see about $120 increase, a year for their property. And the rest will eventually see a higher increase. But remember that FEMA can only, they're held by their statutory rules. They can only increase at the maximum 18% per year. For most properties, if you're pre-firm, you were built before the community joined the flood program, you could see up to a 25% increase unless it's your primary home. So severe repetitive loss, non-primary pre-firm homes, or pre-firm homes that have had, or pre or post buildings that were built after the community joined the flood program, if they've had, severe repetitive loss over the years.
Right. Well, all right. So 70% of us are getting higher insurance rates. What can we do to help lower these rates for consumers and businesses?
They're looking at mitigation. So if you do have an elevated structure, and, put proper vents in. One of the things is, even if you're in a V zone, that high velocity zone that you're right on the coast, right on the water, pretty much, vents didn't matter then, they do now. So that might help their rates. Same with residential properties. If it's elevated, properly vent those buildings. And then if it is a non-residential structure, they can also look at flood proofing. And pretty much it's, you look at your deductible options. What do what's your comfort zone in increasing that deductible to lower that rate?
Yeah, that's a good point. I guess it goes back to some of the risk the ways to address the risk is you can do self-insurance by raising your deductible, but then as long as that way you don't have to come up with the whole amount for rebuilding your home, but you'll have a larger percentage of the amount to pay, but then you can have a more reasonable rate on an ongoing basis.
Right.
So thank you for mentioning how it's supposed to streamline and make it easier for actually quoting flood insurance. You had mentioned about the elevation certificate, that it's not going to be mandatory anymore. How will that work, and how is the Section E? How does all of that work?
The Section E is it states on there that, you know, the property owner can do it, but what it really is measuring from the ground to your first floor. And you put that number in. What's the distance? Is it a foot? Is it 3 feet, 10 feet? And a lot of the properties that are older, are pre-firm homes, you know, might not have ever gotten an elevation certificate. And, you know, they could be elevated, and we don't know, you know. So I think it's in the best interest of the insured. Again, it can't hurt them. It can only help in the rating. So it might be something they want to take a look at and do. Very simple.
Wonderful. So the maximum for NFIP is still going to be $250,000 on the structure, but replacement cost plays a factor now in the flood rating. So how is that all going to work?
So what FEMA has decided was that, you know, like in normal insurance, the more expensive the home is, the more expensive the insurance is going to be. And they look at it as, you know, with flooding, say you have 2 feet of water in your home, next door neighbor has, you know, your home is worth 250,000, next door neighbor's home is worth $1 million, right? You know, what would FEMA be paying out on those two different properties? They'd probably be paying out, if it's not, because 2 feet of water, I don't think would be considered a total loss, but they might be paying out that full 250 on that $1 million home versus that $250,000 home. They might be paying out, you know, $125,000. So they look at the replacement cost as a factor in the rating now. And it's important that, you know, and FEMA determines that replacement cost. We provide them the information, property location, square footage, number of floors, and they determine the replacement cost. We can't change that. And that's only for 1 to 4 family structures. So non-residential buildings, we're going to have a replacement cost estimator, so we know what the true replacement cost is of that building. And they do know that with the non-residential, it's not it's an actual cash value policy. It's not a replacement cost value. So they take that into consideration with the replacement cost.
Gotcha. Yeah. So based with the age of the home and the type of structure. So that's good. So I guess one thing that we've always benefited from here in our area is the grandfathering. And now I know as part of the risk rating 2.0, we're going to essentially lose grandfathering. So
Right.
what is a way to retain our lower rate if we have one for an extended time?
Right. You have existing policies that are renewing have a annual increase cap, as I mentioned before, that 18 or that 25%. So if you're being grandfathered now, it eventually is going to phase out the grandfathering. There's no more preferred risk policies. Newly mapped will get a discount if they're newly mapped. So if they go from that X zone into a high zone, they still would get that discount as well. So they'd be eligible for that.
Tell us about the glide path.
So that's that 18% per year. So FEMA is going to provide what people will see on the new deck page is they're going to see their actual flood risk. That is their full premium flood risk, what they should be paying, or yeah, if it's brand new business, what they will be paying. But the glide path every year will go up. Let's talk about a primary home, 18% every year till they get to that glide path. So you'll see your statutory discounts go down, and unfortunately your premium go up, or you might not see a change at all, but remember that full risk premium, that can change every year. Say the community provides some type of flood proofing, of maybe update the levee, update a dam, do something like that to prevent flooding in their community. They might see that full risk go down.
Yes. So what about real estate transactions? We have a lot of realtors who are very inquisitive about the flood changes.
Sure. Well, right now, there is where somebody can assume somebody's policy. I think flood insurance is the only policy I know that you can do that. So the new owner can purchase from the prior owner that policy and stay within that glide path and just continue on with that policy. But one thing new for October is they call it a new policy real estate transaction, because assumptions sometimes don't work. Some companies don't do assumptions. For example, like a USAA, you have to be a member. So if I bought your home, you're a USAA member, I'm not, I can't get that policy. Or say your policy is going to, that policy that you want to assume is going to expire and, come up for renewal in 2 months. Some banks or mortgage companies won't allow a policy that short. They want like at least 6 months or a year full policy. So FEMA is allowing us to, if there's an existing policy on the day that that property, was sold, that insured can take advantage of the glide path as well. So we would need the policy number as well as the prior company that they held it with, and FEMA would maintain that glide path for them. And another good thing is, say they bought the house or the business and they find out 6 months later it did have one, they didn't realize it. We can endorse that policy to give them that glide path up to 365 days from the date of the sale.
The actual sale. That's good, because that's going to be an improvement. So some examples of what we're seeing in our area. In an X zone, which is the preferred zone, we were quoting a new home buyer. The home was $250,000. The rate before risk rating 2.0 was about $500. After risk rating 2.0, it's $1,800. That is so extreme. We kind of feel like we're being picked on. Can you address that a little bit?
I know, but you're not being picked on. I know, like California feels they're being picked on because now they're getting a surcharge from like a tsunami as part of their rating. One state that might be seeing an increase in not coastal, like Pennsylvania. Pennsylvania has a lot of flooding. We saw the flooding in Tennessee. Vermont, certain areas up there. So it's not just coastal communities. They're looking at, somebody that's in an AE zone on the coast does have a higher risk of flooding versus somebody, in say Kentucky, that, they're still in an AE. The type of flooding's different. Is there more chance of a total loss versus, a partial loss? So they look at that. They're looking at it to be more equitable for, and also for people to truly know what their risk is of flooding. Because say that X zone, I don't have to buy it, but when they see $1,800, they say, gee, maybe I have a higher risk than I thought I had. But yeah, we're seeing it's different areas. I mean, I work with somebody that lives in St. Petersburg, Florida, and right now her policy, she's got a preferred risk policy, and she looked at it as full risk, and it went from like that $500. Hers went up to like $5,000. So she's really nervous. She's buying a policy.
Wow.
She bought a policy with a 30-day wait to ensure that she was under the old program and she would have her glide path.
Yeah. Wow. Yeah. So, it's just some of the differences in the premium are just staggering. And so it's causing a lot of fear, especially for people that are interested in moving to our area. And I know that the ear of Congress has been evoked. Do you think Congress will be able to delay the implementation of risk rating 2.0?
As I was on a call right before this with a couple people from FEMA about actually the reauthorization. Is it going to go through? We're going to have a government shutdown. What do we do? Are there new rules that the companies have to follow? They're still working that part out, but you never know what Congress is going to do. But risk rating 1 has left the building. It's out there. I don't know about pulling it back. If they do, I know we've said, well, maybe we can run both. And if risk rating 1 is cheaper for the insured, give them risk rating 1. If risk rating 2 is cheaper, give them risk rating 2. That way, until Congress can understand how the rating works, what the impact truly will be on their community, what they can do. But, there's always a chance. We saw with Biggert Waters back in 2012 where, they said, oh, pre-firm properties have to pay their full risk rate, and how quickly, Congress turned around and said, halt, refund everybody that money, change it. So again, Congress can do anything.
Yes. So we shall see. We shall see.
Yes.
But so NFIP is no longer the only game in town.
Right.
Can you speak a little bit to the private flood markets that are becoming available as an option?
Right. There are a lot of private flood markets out there. I'm not an expert on the private flood. My role is really with the NFIP program. But, some of them have better coverages. Some of them do replacement costs for the contents, higher limits. They're not capped at that $250 for single family or 1 to 4 family homes. So they can offer higher limits of time. So I think it's important that people check out, both, looking at private versus the NFIP and making a decision there.
Definitely. Yeah, so you definitely want to be checking with your insurance agent. There's also a flood advocate that's available to us that we can contact that works. They're directly working with NFIP. Is that correct, Patty?
Correct. The flood advocate is right there at NFIP. So if people have questions, about their rates or things like that, they can reach out to them, or they can reach out to their agent who would come to the Write Your Own Company, and we could submit it on their behalf to FEMA directly instead of going through the advocate. Unfortunately, where FEMA is doing the rates, they have all the information. They're just providing us back the rating elements to that. They're not telling us distance to coast. They're not telling us, the geolocation, if they're doing a surcharge for a tsunami or, storm surge, things like that. So somebody wanted to get, looks at their rates and say, this just can't be right. We can always submit it. And yes, they can go through the flood advocate if they want to as well.
Wonderful, wonderful. I think we have a few questions from the audience.
Yes, we do. And thank you, Patty, for all of that. And Angelyn, I guess the first question is, how did this happen? It seems that there's been very little public awareness. This is coming from Janice, and I agree with her. And I'm sitting here also as a consumer saying, okay, it goes into effect October 1st. All right, I don't know what to do. What am I supposed to do? Am I going to just get a bill in the mail saying, here's your new rates?
Well, as Patty was describing, the new rates will go into effect October 1st. But if you have an existing policy, then you are kind of protected from the full rate. Although on your next billing, you will see what the full rate is. So for an awful example, let's say that my home, which is on Dunbar Avenue, I'm currently grandfathered. I'm currently paying $600 a year. But when I get my insurance bill for the flood insurance after October 1st, it will show that my new rate is $4,000. And I'm just trying to give you a really awful example. But I won't pay that this year. I will pay the 18% increase this year, which will be added to my $600 rate. So I'll pay a little bit each year as I'm moving toward that horrible $4,000 number, and that Patty was describing will also change over time.
Well, I know right now, what we can do is FEMA is saying if risk rating 1 is better and your policy effective, your renewal date is October 1st through March 31st of 2022, we look at the rates and we say, is risk rating 1 better or risk rating 2? And if risk rating 1 is better, we'll allow you to, we'll just send you a bill for risk rating 1 and you'll continue on until the following year. Starting April 1st, everybody's got to be rated under risk rating 2.0.
Right, that's a great clarification because for new policies, it's effective October 1st, but for renewals, it's not really effective until April of next year.
Right.
That's good clarification.
All right, that is definitely.
And it's important too that if you do have a policy, don't let it lapse.
Yes, can't stress that enough either. Yeah.
Can't stress that enough.
They're becoming quite punitive on letting the flood policies lapse. They used to be very generous. You could get it back after 90 days if you wanted. And yeah, that's off now, off the table. If you let it lapse, you're going to end up paying the full rate when you go to get the flood policy back.
Yeah.
So you talked about the third party coming in and conducting a survey. Who's considered to be a third party? This is from Janice.
They would be a non-government entity. So right now they're using data sources from FEMA mapping. FEMA has a Great Lakes analysis. They use NOAA. They use the U.S. Army of Engineers, and but the third party would be anything that's not FEMA. So like for replacement costs, they use CoreLogic, which is a large company that does replacement costs throughout the country. And cat risk, they get some modeling from them, as well as, and I don't know what AIR stands for, but that's another third party vendor that they use to help with maybe, I believe, like geolocation tools, things like that.
Right, and that's all used, all of those third parties are used to, as a background for calculating the rates that we'll receive through the flood insurance carriers.
Exactly.
So the next question is, you were talking about the 18% cap.
Mm-hmm.
How was this set? Who set this? I mean, how did they?
Congress.
Cap.
Congress set the 18 and the 25% cap for rate increases. on
So
existing
it
policies.
sounds like we need to go to Congress and express to them how we, feel about
Sure.
this issue. And I know I've seen some press releases from Senator Hyde-Smith's office and Senator Wicker's office as well.
There's also a flood coalition group made up of 26 different states that we're a strong proponent of, and they have also petitioned Congress to try to keep this from going into effect. So again, we shall see.
That's right.
All right, next question is from Patrick. Considering the new variables FEMA is using to consider risk for a property, how should someone who is building factor in the elevation of their home? So would, for instance, would building to BFE be per flood zone still be a rule of thumb?
Yes, that's not changing. So the floodplain management side is not changing. And I know a lot of floodplain managers are concerned about that because they say, hey, I'm telling you, you have to build to the BFE. And, maybe building a foot above or 2 feet would be more advantageous to somebody building. But, there's a lot of questions behind the floodplain managers have lots of questions for FEMA on that.
Yes, it's going to be very interesting because it could get to the point where it's almost at conflict with what the local communities are doing, because they're trying to get you to think in terms of being over base flood elevation, whereas now that may not be how the flood insurance is done. But it doesn't matter. It's still the right thing to do when you're constructing a new building for your business or for your home.
Correct.
This next question is from Wendy. It's about glide paths. So not everyone will go into a glide path. What does someone have to do to be sure they are on the glide path?
So the glide path is really your grandfathering, your rates as they are today, and going into that 18%. So it's really your statutory discounts. It's your pre-firm discount, the grandfathering. It's that rate that you already have. If that's more beneficial, that's where that glide path comes in. They'll keep that rate. They're not going to increase it more than that 18%.
Right.
So they don't call.
The way to keep your glide path is to make sure your policy does not lapse. That's
Exactly.
the whole trick to it. Don't let your flood insurance lapse.
Yeah.
All right, here's the final question. Is FEMA considering changes to high fire risk or tornado risk zones in addition to flood zones?
Honestly, I have no idea.
I don't know. Yeah, that would affect flood insurance.
Unfortunately, I don't have that answer.
Subject for another day. Can y'all go back over as a final wrap up? It sounds like we do need to let members of Congress know that we do not want this to go into effect. And also, would you go back over, I think this is really the critical information right now is, okay, this is supposed to go into effect October 1. I guess if we don't have a government shutdown, all kinds of factors going on here. But it only affects you for new policies. Okay, say that again.
It only affects you for new policy.
And then, okay, I'm not a new policy. Okay, I have flood insurance. I'm not going to see these rate increases until next April.
And then it'll be capped on your glide path at the 18% or 25%, depending on which program.
But it could eventually get higher.
Yes.
Okay.
It'll get higher each year until you get to your actuary rate, which will be reflected on your insurance
Renewal.
Policy debt.
So I'm gonna be at my renewal. I'm gonna find out that at some point in time, my flood insurance premium is going to be X, which could be a lot higher, or it might not be higher. It might be lower, is what I heard also. Is that true?
Well, that's what we hear.
All right. Well, this has been great. I don't think we have any more questions from our audience.
One final note on that. It is scary. It is awful, but we've dealt with high rates before, and you know, when after Katrina, the wind rates were ridiculous. Now they're back in a more reasonable realm. Flood insurance now is going really high, but the good news is we've got options now with the private market. So understand what's happening, read your policy, take a look at what your actuarial rate is going to be. And when the FEMA flood insurance gets too high, look at the private markets because they are coming in. Right now, we have a lot of private flood that we're writing that is much lower in a starting out position than FEMA is. It doesn't always happen because, again, the same premise that you see with the NFIP product, that it depends on where you live, what's your exposures, if you've had claims, that kind of thing. So the house right next door to you could be a different rate. And you just need to understand and ask questions and look around.
So when do we need to contact our agent to start looking into this?
You can do it now, but there's probably not information available on your specific rates. When you get your renewal in is when you'll be able to see what it's looking like and if you need to go ahead and start looking at other options.
Great. Well, this has been a great coffee call. Thank you, Angelyn Zeringue, brought to you by SouthGroup Insurance. And we really appreciate Patty coming in from Wright Flood. And we cannot thank you enough for all this great information. Our next Power Hour coffee call is coming up on Friday at 10 a.m. via Zoom and Facebook. And we hope that you'll join us to welcome the new director of the Hancock Library, John Berdecka. He comes to us from Northwestern University, 15 years there as in library services, tremendous amount of experience. We're really welcoming him to our community, he and his family. What a great resource to bring to Hancock County. Thank you, and we'll see you on Friday at 10.
Take care.
Thank you.